I think most investors have now been woken up to the stark reality that bull markets do not last forever. We saw a time of tremendous growth over the last 18 to 20 months, and I'm undoubtedly sure that a lot of people made a lot of money over this period, especially those that invested the majority of their money right when the pandemic shutdown happened. Now, the market recovery was swift, and there were events that helped boost investor returns, like the rise of SPACs, and who can forget the Wall Street Bets GameStop saga. Point being that if you invested wisely during this period, you probably ended up making a lot of money. But now that period of rich valuations and overbought stock prices is over, and the market is now moving in the opposite direction. Now, with everything going on, there's a likelihood that we could be headed into a bear market. And we're going to talk about how to keep making money in a bear market. So if that sounds like something you'd be interested in, please drop a like down below, as it does help out the channel, and let me know what kind of videos you like, and I can keep making that sort of content. So first, we're going to cover some actions that apply to your mindset, and then we're going to talk about the decisions to make based on having that mindset. So please be sure to watch the full video, as this helps build your mental fortitude and serves as a reminder, because too many times we see people say buy low and sell high, and it's easy to say until you actually get into a bear market, and it becomes more difficult to actually do those things. So with that said, let's get right into it. Now first, let's talk about what exactly a bear market is. Common knowledge is that a bull market is when stocks are up, and a bear market is one where stocks are down, right? Well, if you haven't been investing long, you'll probably think that the most recent drop in the market is a bear market. I've actually seen quite a few people talk about how we're actually in a bear market right now. Well, I'm here to tell you that those statements are inaccurate. At the time of this recording, the S&P is down 9%, the Dow is down 2% or so, NASDAQ is down over 13%. Now, are these sizable drops? Yes. But is this a bear market? Absolutely not.
Okay, genius. What's a bear market then?
Well, I'm glad you asked. Now, a bear market is a market typically defined by 20% or more drop from the recent high. Now, this is different from a correction, which is any drop of 10% or more. Typically, the S&P 500 is a key benchmark used to gauge the overall market. But this 20% drop could apply to any of the indices. So if the NASDAQ drops below 20%, it would get upgraded from being in a correction to being in a bear market. And the same thing applies to the Dow or the S&P if they fall below 20%. You can even apply this to individual stocks. Let's take RK, for example, which is down over 60% at the time of this recording. Now, this ETF is currently in bear market territory, and you could say the overall sentiment is bearish. Now, you could point to a lot of reasons why a bear market could happen, but it basically boils down to this: risk and uncertainty. Most investors are risk averse, especially those who are managing millions and billions of dollars. So the greater the risk, the more people will look to sell in order to preserve your capital, which results in greater volatility and a down market. Now, at the recording of this video, there's a lot of geopolitical instability that is resulting in a lot of fear and uncertainty in the market. Now, these are indeed scary times, but times like these present opportunities to set yourself up for the long run while things are beaten down. As Warren Buffett is famously known for saying, be greedy when others are fearful. Now, taking those wise words in mind, here are some guidelines to consider when investing in a bear market. But honestly, you can apply these whenever, because no one likes losing money anyway. Number one, resist the urge to sell. Now, when a bear market occurs, and we're talking about a bear market, not a correction, right? Now, when this happens, a lot of people sell off their stocks. And since you want to minimize your losses, you might be tempted to sell off as well, since everyone else is selling off. Well, don't. Selling off in a bear market is one of the biggest mistakes you can make. Not only does this lock in your losses, but then you miss out on the upswing when the market does recover. Now, some folks will try to time their investment by trying to time when to sell and when to get back in. But trust me, this is a bad strategy, and this does not work. Now, there's a reason why the saying goes, time in the market is better than time in the market. Time in the market is the only way to guarantee that you can fully participate in the market recovery. But what if you want to sell your investments so that you can buy other investments that are on a discount? The best way to avoid having to do this at all is to ensure that you have cash and to plan out your investment strategy. Plan your allocation so you have cash reserves ready to deploy, rather than depending on selling out of your long-term investments in order to make a purchase. So lock down your strategy, allocate some cash. Now, it might be hard to watch that cash sitting there. Trust me, I've been there, because you're eager to deploy, so I get it. But being an investor requires patience, so consider this as a little bit of patience practice. Next, let's look at another strategy, which involves buying short and long-term puts. Now, if you feel that the market is heading into bear territory and you have a sizable long position, another strategy is to buy short and long-term puts on the S&P 500 or the NASDAQ, or whatever stock you want. Now, a put option is an option that represents the right to sell 100 shares at a specific price, and this is called the strike price, and this expires after a certain amount of time. Now, if you buy a put on the NASDAQ or the S&P, for example, and the market declines, then the value of your puts will increase in value as those indices drop. Now, keep in mind that trading options is based on leverage, and some brokerages may have margin requirements. Also, since options are essentially leverage bets, they can increase or decrease by a higher percentage than stocks, meaning that your gains can be amplified, but also your losses can be amplified too. Now, since put options expire, there is a time decay, meaning that the value of your put option will decrease in value the closer it gets to the expiry date. All in all, this is a very risky strategy, and it does require some experience, as it's very easy to lose a lot of money. So even though I mentioned it here, I'm personally more of a buy and hold person, so that aligns to my strategy, but it's up to you. You do you. And as always, do your own research. Next, let's talk about automating your investments. Now, when you automate your investments, here's what happens. You're steadily participating in the market by dollar cost averaging. And what this does, like I said before, is ensure that you fully participate in the market swing. Now remember, time in the market is better than timing the market. Now the issue with timing the market is that you have to be right twice. So you have to be right on your exit and your re-entry. And like I said previously, this does not work because you can't outsmart the market. Now you may think you can, but the market doesn't care about your confidence. So add consistently to your positions and be sure that you are adding to companies that you have researched and have a strong balance sheet. Now, if these are good quality businesses with a strong balance sheet, then they will recover. I could really make that its own point. Actually, you know what? Let's do that. I'm calling an audible here. So I'm gonna say focus on quality. Now, when the market goes down and the economy goes bad, companies that are over leveraged or companies that are not profitable yet get hit the hardest. And in some cases, they go out of business. And if you notice, the quality businesses persevere and maintain their competitive advantage. Now, I say this to say this. When you're investing, especially in a down market, you want to look for companies that are flush with cash and have that competitive advantage with a strong balance sheet. Because over time, these companies will bounce back and continue to be profitable, and in some cases, be even more profitable. So when you really think about it, a bear market brings a time of fear. But if you're able to stay focused and employ these strategies, you can actually do well during the times when other investors are selling out or locking in major losses. Your portfolio will be either green or less in the red than a lot of other investors. Thanks again for watching. If you found value out of this video, please drop a like down below, as it really does help the channel grow. And while you're at it, kindly subscribe to show your boy some support. And with that said, I'll see you in the next video. Peace.